All right, so our video series on whether or not Karen should take Social Security at 62 or 70, pretty clear she should take it at 70. I'm not ready to make that assessment yet. I'll do a wrap-up video where we look at all the spreadsheets. This one we're going to do when we're going to model a reverse mortgage and take that at 62. And then we're going to say, okay, she'll get a reverse mortgage at 62 as a way to bridge taking Social Security till 70, and then she can take a reverse mortgage at 62 as well as a way to just generate other income with Social Security at 62, and then we'll see what they look like. Remember, with the reverse mortgage, the issue is the income comes back to you tax-free. It is return of principal, essentially. That's what's happening here. So you don't have to pay any income tax on it, which is wonderful if we're bridging Social Security and Roth conversions, I might add. So we'll see how that shakes out. The drawback about the reverse mortgage, frankly, is that it is a debt. I mean, it's going to have to be paid back at some point. And the nice thing is non-recourse loan, which means you'll never own more than what your house is worth, which is part of the fee that you're paying for. I'm not going to have Karen paying it back. So what I'm going to do is I'm going to eliminate the house as an asset. All right, I'm going to eliminate the house as an asset. I'm going to assume that because we have her live until 90, essentially the debt on the reverse mortgage will eat up all of her equity. And look, that's probably a pretty significant assumption. I get that. The issue is I just don't know how to model it when we have such a variability in reverse mortgages. So it's a tough one, but I'm gonna model it as if there is no equity left over at her death. Now that means simply that her heirs won't owe anything. All right, they're just going to sell the house and pay off the reverse mortgage and walk away, regardless of what the value of the home is, regardless of what the reverse mortgage is. I'm outside, so if you see me sweating, that's why. All right, so let's dive into this. So first thing we're going to do is we're going to go to my man Wade Fow's retirement researcher website here, right there. And we're going to model a reverse mortgage. So we're going to accept the cookies there. And we're going to go up to resources, calculators, reverse mortgage calculator. So remember, Karen is 62. She has a house that's appraised at $300,000 with no debt. All right, and we got to put her age in here right there, 62. So what I want to do is we're going to do a couple things. We're going to have where she does a term or a tenure. What's the one where he gets a monthly a tenure? Okay, we're going to do a 10-year payment, which says she's going to get a monthly payment on her reverse mortgage for the entirety of her life. All right, so remember, with a reverse mortgage, we got a LIBOR rate of 2 3/4, basically a lender's margin of 2.5, 2 1/4. So essentially, the fee is going to be a little bit more than about 5.5%. And so if we take our trusty calculator and we're taking out, let's see, bear with me just a second, she will be able to get, how much is that going to come out of there? 300? No, it won't be. Yeah, 300,000. She'll get 41%. We're not going to have any origination fee, initial mortgage insurance, can't get around that, other closing, okay. So she can have a line of credit of $125,000, and what we will do is we're going to say she's going to be around for 30 years. Oops, 125, that's our present value. 30 years, we're going to do 30 years at 5 point, what's that, 5 point, yeah, right at 5.5, 5 point, we'll just say 5.5%. No payments. Future value would be 622. Okay, so let me just, did I get that right? Hold on just a second. Let me just make sure I got that right. Yep. All right, so we got $125,000 is her present value, no payments. 5.5 is the interest rate. 30 years. Yeah, 622. Man, that can't possibly be right. Yeah, that's what I'm showing. Huh. All right, that's I guess that's right, 5.5. So basically the house, all right, so it'll be, her house will be, the debt, if she were to borrow that, will be $622,000. The home, we'll say it appreciates at just 2%, so the home will be $300,000 is the present value. Let's say 2.5% to keep it simple. And that home would be worth $629. All right, so that's good. This perfect. So basically that is the drawback about the HECM, the reverse mortgage, is the facts are she is paying this rate. Well, she's not paying it, but she has that line of credit that's costing her 5.5% a year. And this could change too. And now we are getting rid of the origination fee, so we do have some Upfront cost $8,500, but that'll be factored into the loan, I think. Yeah, percentage of upfront cost we finance. We'll say 100%. There we go. I want to put that in there, and I want to 116. Okay, so basically this is good. We are not going to have any equity at her death, but she has $116,000. She could take it as a lump sum, or she'll get a monthly payment, a 10-year payment of $606 a month. So let's just remember, I'm just going to use round numbers, $600 a month. And that'll last as long as she remains eligible for loan, i.e. she stays in the house and doesn't die. All right, so we're going to use this. We're going to go back to profile. Essentially, all I'm going to do is I'm going to delete the house on the net worth. I'm just going to say gone. Gone. All right, we'll just delete this. We'll just say current value 0. All right, so that way we'll remember she does have a house in case we forget. But remember what her total so her total net worth is $331. So what we're going to do is we're going to put an income stream. All right, we're going to put add income, and we're going to do, I guess, annuity. Let's see. Do I get cost basis? Okay, cool. There we go. I think I can do it. It doesn't give me the percent. All right, so let's just do reverse mortgage monthly income. All right, and her annual amount, what did we say? It was $600 a month, right? So is that what we said, or $600 a year? Annual, her payment, monthly payment is $600 a month. All right, sweet. So that's $7,200 a year, and I should be able to do an exclusion amount of oh man, what's the it's customized income exclusion right there. Sweet. 100%. That's exactly what I'm talking about. Fantastic. And we're not going to have any survivor benefit there. Okay, cool. And we'll just put that as 0. Exclusion amount, that just means how much of your principal or your payment is excluded from income taxes. In this case, it's the whole thing. All right, so what do we have for Social Security? I can't remember. When did we have her taking Social Security? Here's that 70. So let's look at this. You ready? So remember, PIA is $2,000 a month. So she takes Social Security at 20. Oh, actually, I got to go back here. When do we start this guy? 2019 for life. All right. And no, we got to make sure we get rid of that. No customized increase. There we go. All right. So she takes Social Security at 70. The monthly payment will be $26.20. All right. Let's see where we got, man. All right. And then because you'll get the delayed earnings credits. All right. So retirement. We're going to hit retirement. See what we're looking like now. And then, of course, got my spreadsheet out here, which we will use to see what we're looking at here. All right, let's go, computer. All right, so she still has 100% probability of success, 1.071 million. Let's take a look here. And you can see the confidence level is pretty high. Not one time does she get anywhere near running out of money. But let's see about the cash flows. That's good. I'm liking what I'm seeing here. Cash flows, income. Remember, this is taking Social Security at 70. So income flows, that's our reverse mortgage. Expenses are $2,500 a month, which is $30,000 a year. Tax payment is $3,025 because she got to pull the rest of that money from someplace. Her net flows are $2,585. Presumably, that's going to come from her. Or it's going to come from her IRA. Let's just make sure. Withdrawals from, yep, $2,585 comes from her IRA. Okay, good. I like what we're seeing here. And then once she has her RMDs, there's no more mandatory, no more withdrawals from her IRA. Instead becomes RMDs. I bet, and that will be 11,000, 12,000, 13,000. Okay, good. I like this so far. All right, so her income flows are coming from her reverse mortgage here, and then from pulling money out, $25,825 from her IRA, and paying taxes of $3,000 on that distribution. When she hits 70, she's going to have RMDs, required minimum distributions, and income flows of $45,000 total because it'd be $7,200 from her reverse mortgage plus her Social Security kicking in. And so here you can see net flows are positive. All those net flows are going reinvested back in a taxable account. Their taxes. All right, so let me pause this, put it on the spreadsheet, and see what we come up with. Hold on just a second. Here are the taxes she paid. I was pretty surprised to see they're pretty look pretty significant, but let's find out here for sure relative to I mean, let's just see here. So look at this. I mean, we got, effective 9% tax bracket goes up to, was that 13, 14, then falls down, which is odd. When RMDs kick in, it falls down. And the reason for that is because she doesn't need to take as much out because she has Social Security kicking in. But then it goes up like crazy, man. So it goes up like crazy because she's not having to take anything more than the RMDs essentially. But that's okay. That was interesting. So anyway, her total taxes paid were 172, and her total net worth at her demise was totally in liquid accounts, and it was 1.3 million. All right, so that's good. I'm wondering if we can make this better though. All right, so let's stop there. We'll do another video where we do the same thing. I want to do some Roth conversions though at between 62 and 70 and see what that looks like. I think we can get some taxes a little bit situated better to reduce some of those taxes. So I think what we're going to do, take Social Security at 62 and do Roth conversions combined with a reverse mortgage. Now that's going to be interesting. That's going to be interesting. Let's see what we find out. So stay tuned. Thanks.